Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Thursday, December 18th. Today on the show, we are talking about the Information's exclusive reporting about how a new funding round at OpenAI could value the company at $750 billion. We're bringing on the reporter who broke that story. I'll then be talking with Robinhood's chief brokerage officer as the trading technology firm unveils new AI features and wades deeper into the world of prediction markets. We'll also then address that steep drop in Oracle shares earlier this year after news that a major financier for its data center backed away from the project. And we have an exciting lineup of executives this morning for you with the CFO of Lyft and the CEOs of Axios and Tubi. It is a big show, so let's get right on into things. The Information is first to report that OpenAI has discussed raising tens of billions of dollars at a valuation of $750 billion. Joining me now to discuss that is one of the reporters who broke that story, Shri Mupidi. Shri, welcome back to the show. It's great to have you here.
Excited to be here.
So what do we know about these funding talks?
Exactly as you said it, OpenAI has been in talks to raise tens of billions of dollars at a valuation of about 750 billion. It's not clear to where exactly the valuation would land or how large the round itself would actually be as well. It could be as much as 100 billion is what we learned. And that's crazy because that's like one of the largest rounds that we've ever seen in history. And so I'm excited to see how the round fares. Where would a company like OpenAI actually get this type of capital? The next couple of weeks will be really exciting.
You've broken a number of the contributions that funds have made to OpenAI's endless pursuits to fundraise. Who do you think is in the mix here in terms of sources of funding? Who do you expect Sam Altman would be making calls to maybe fill this new round?
Totally. So we had previously reported that SoftBank obviously is leading the $40 billion round. So they're putting in roughly 30 billion so far. And so I'd assume that SoftBank would come in again as part of this round. I'm not sure exactly how much though, because obviously committing 30 billion is a large number in itself. But that means that other financial investors like SoftBank, for example, Thrive Capital, Coastal will likely also like to top up. But even still, I think that pool of financial investors would only make up like roughly 10 billion, maybe more. But the large portion of the rest of the round would likely come from other strategics. So that means, for example, potentially Microsoft, which has been an original partner of OpenAI since the beginning. They had previously invested more than 13 billion over the course of OpenAI's history. We've reported about Amazon potentially investing or has at least been in talks with OpenAI. It's not clear to us that this is the same round as the round that Amazon has been talking off, but I'd imagine that Amazon discussions maybe perhaps kicked off this potential 100 billion round.
Right.
Then also beyond just the strategics, it could be sovereign wealth funds, for example, in the Middle East or Asia that have large pools of capital. We had previously reported that OpenAI had been in discussions, for example, with the Public Investment Fund of Saudi Arabia, as well as India's Reliance, but those discussions didn't fare anywhere, at least for the 40 billion round. And so those are also potential markets to be tapped.
So everyone, I guess, is the answer. Literally
Right.
everybody, anybody that has money is on deck. It's a good analysis there. Look, I want to pivot to another story that you published today. You wrote this story with a couple of our colleagues about how the organizational changes or the organizational structure at OpenAI has, in some cases, actually inhibited some of the progress that the company has been making with ChatGPT. Talk a little bit about the reporting that you found.
Totally. So, what we found, having talked to a lot of former employees, current employees, et cetera, was that big model upgrades led to huge surges in usage in ChatGPT in prior years. But in more recent times, employees actually realized that big upgrades to model intelligence didn't actually necessarily lead to how people use ChatGPT. And that was particularly the case as a result of reasoning models. Reasoning models are essentially very good at answering hard questions. So, this could be like math questions, science questions. They like won different types of Olympiads and competitions, but they take much longer to come up with answers for users. And users by far prefer having quick answers much faster than having this like long-winded sort of time to spend to actually answer the question. And so that disconnect, some folks that we talked to believe that helped Google make gains against OpenAI. So I think that was basically the crux of the story of how the challenges between the
Right.
reasoning models and how that led to maybe not the best gains in usage for ChatGPT was confusing for some folks.
Now, one of the things that your story hit on, which I'm happy it did, is the product team and the research team at OpenAI and the extent to which those teams are carrying the organization. And we know that OpenAI is so focused on research. I mean, is there a tension at all between the product and the research team insofar as who gets resources? Have they changed the focus at all?
Yes, exactly. I think the research and product tension really mirrors the tension that like product and engineering teams maybe had in like other tech forward companies. So, for example, I'd imagine this would have been the case at companies like Google and Stripe when like engineers were the force of the company and like product took more of a backseat. I think what we're seeing now, similarly, is that research is at the forefront at ChatGPT. And in a recent blog post by Fiji Simo, she also explained that like OpenAI still is a very research oriented company. But this type of tension, I think, basically shows that what research works on at ChatGPT, or sorry, at OpenAI, doesn't necessarily lead to improvements in the product experience for ChatGPT users. And ChatGPT, as we know, drives the most revenue for the company.
Right.
And so this shows to me that there is still a large opportunity for ChatGPT to further be productized, is how people talk about it, where it's basically there are opportunities for improvements in ChatGPT itself for users to have a better experience. So that could be, for example, maybe like having a notification to help you exercise more because you have indicated that you're interested in that, or having e-commerce integrations, which, for example, we've reported that Amazon has been in discussions with OpenAI, and so there's still
Let
opportunity.
me ask you about Fiji Simo. You mentioned Fiji Simo. Has Fiji Simo's appointment or her role, has it helped the issue at all?
I'd say she's been making pushes towards driving more product features launched. So, for example, she, I believe, helped the company launch a new image or model earlier this week that is integrated into ChatGPT and have ChatGPT surface images more a part of the ChatGPT conversations. But I think honestly, it's been too early for me to be able to particularly assess what Fiji has been done, but I'm looking forward to sort of what the next couple of months, especially, will be as the company's in its code red.
Great. Well, Shri, I want to thank you for coming on. That is Shri Mupidi, our OpenAI and Anthropic reporter here at The Information. Robinhood announced new AI features this week to help traders make sense of their portfolio, and the company is also wading deeper into predictions markets. To tell us more about the company's strategy overall, I want to bring on Steve Quirk, Chief Brokerage Officer at Robinhood. Steve, welcome to the show. It's great to have you here.
Thanks so much for having me. I really appreciate it.
Well, I'm excited for the conversation. You had some exciting announcements earlier this week. Look, you made this string of announcements about AI features. And
Mhm.
the question I want to ask just at the outset here is, can the AI do the trading for you? How does it work?
Yeah, we're not quite there yet, and I don't even know if if our customers wanna go all the way there, especially I mean, the majority of them probably won't wanna go all the way there. But what they really would like is some help in identifying, if I'm a technical person, identifying patterns that are of interest to me or opportunities for trades. And then having AI capabilities help me do the research and optimize that trade. Because I think what you experience with a lot of people who are very active is they of course want all the help they can get in identifying opportunities and even making sure that they optimize those opportunities. But there's a certain sense of fulfillment they get from actually doing it themselves.
Right.
And so I think that's the aspect. And by the way, that the other part is the part that is the most labor intensive and takes the most amount of time. So if we can help them in that component, I think it's going to be game changing for many people.
Right. Now, I just want to, play this forward a little bit. And I know you said you're not sure you ever will get to the point where AI
Yeah.
will be doing the trades for you. But look, I have never really done any hardcore trading in my life.
Yeah.
The difference between what AI trading would be and then like algorithmic trading, what
hmm
would be the functional difference there?
Well, I just think it's taking it to the next level because algorithmic trading has been around for quite some time.
Right.
And so like even so one of the first things that we rolled out from an AI standpoint, and I'm talking about client facing because we've done a lot internally that's been really helpful for customers. But one of the things for what I'll call the more sophisticated traders that we first rolled out is a lot of them do some scripting or scanning for either indicators or opportunities of stocks that are looking like, whatever variables they want to put in. But in many instances, they have to either do that scripting themselves, learn a language and then script, or create these scans, which can be kind of time consuming. And what the AI capabilities that we've rolled out give them the opportunity to do is either do text or speech and just put those in, and then they can save them as a preset and even share them with other people who have interest in doing that as well. That's
Hmm.
very, very powerful because you're basically taking the universe of people who are qualified to be able to using these capabilities from, like call it 1% to a much larger audience. And many people want that help.
Whose models are you using under the hood?
Our own, we're using our own because
Okay.
we have a lot of customer data.
Built
And
them
so,
built
of
them your
course,
built them yourself.
yeah, because think about it, we're 26 million customers and a lot of data. Now, I mean, for the information, of course, we have to go outside, because you're talking about market moving information. So, we have many, many different news sources that we use.
Right.
And then that's the source of information for a lot of what's publicly traded.
Now, the other slate of announcements you made is the company's move to wade deeper into prediction markets, which I know
Hmm.
is the most exciting topic everyone wants
It
to talk
is.
about.
Everybody wants it. It's the topic du jour over the holidays.
Well, and I didn't even think about that. I mean, people are going to be talking about it a lot this Christmas, I'm sure,
Hmm.
over dinner
Yeah.
and stuff like that. I want to ask you a bit of a question here. Look, if Kalshi and Polymarket didn't get so much traction, if they weren't the names that we know them to be in the tech sector right now,
Hmm.
do you think Robinhood would have opened a predictions market?
Um, it wasn't like so if the sort of the genesis of prediction markets, I would argue kind of started on even more traditional exchanges like the CME, which is now getting into it as well, or ICE. So they, came out with some binary products and some futures on weather and things of that nature, which just give you a little more precision. So in other words, if I'm a grain person who's, interested in grains, and I'm either hedging myself or speculating, what I'm really speculating on is the weather. And so like they've just gotten closer to what the real source of the interest is in terms of the investment thesis.
Right.
The prediction markets in Kalshi and Poly and others, they really capitalized on the interest. It started in, I think, the biggest one that, at least from our standpoint, was around the election. And of course, the election is going to drive a lot of movement in people's portfolios. And the idea that I have to parse out which component of my portfolio is going to move which way, depending on who's elected, is work. But the idea that I can just make an investment thesis on the election, which essentially either
Right.
allows me to capitalize on my portfolio or protect it. It's much easier and much more precise. And that, like the interest on that, which we rolled out, was like 500 million contracts in a week. Insane, like crazy, crazy, crazy interest. And then it grew because they want to express opinions on, will the Fed move interest rates? Will Kevin Hassett be the next Fed? Everything. It
So
just
even if Kalshi and Polymarket didn't get the traction that they got, you still would have opened a predictions market, probably. You're saying.
Well, I mean, in fairness to them, they are the exchange. So like we're not an exchange right now. Like think of it very similar to our equity model, which is we route to exchanges, or option model. We route to exchanges. So we need one of those exchanges, and there's Forecast X as well. That's who we started with. So that's kind of the model for us. We're the distribution. We have the customers. They're the exchange that is creating the product, and then we're going through them. So I mean, in fairness to them, either them or the CME or somebody has to create that
Right.
because
Right.
we're just the agent out here. Yeah.
How do you protect against insider trading on these prediction markets?
It's a good question because it's something that's been a kind of a hot topic. It's not dissimilar to the a topic that was brought up when crypto really was getting its legs, and they were saying, how do we ensure we already do this? Like we do it at scale because we have to for insiders on insider trading and corporate people have corporate MNPI, material non-public information. We already have the template and a model that exists. So I would argue like bringing this into our world is actually helping it with from the standpoint of integrity because we already have the model. We know where you're employed. We know everything from a KYC standpoint about you, and so we have those protections along with the exchanges.
And so Robinhood is scanning the predictions markets trading that are happening on its platform the same way it's monitoring any other trades for any suspicious
Exactly, and
activity.
looking at who's trading it. Yep.
Okay. And, I do want to ask about regulation here.
Hmm.
Speaking of predictions in 2026, are
Yeah.
you expecting there to be more regulation in 2026 around these prediction markets?
I think what we'll get is more regulatory clarity, which is something that again I keep going back to crypto, but we were looking for more regulatory clarity over the course of the last 4 years, and I think we're starting to get it, or we have been getting it, which is helpful because again we're highly regulated, we're very accustomed to being regulated. We like regulation because it lays down the template of what we can and cannot do very clearly, and so when there's ambiguity, it kind of puts us in a strange position with respect
Mm.
to what we want to do. So I'm anticipating more clarity. Yes.
How big a business do you think prediction markets will or could become for Robinhood? What percent of your revenue do you think you could make up 3 years from now?
Well, if you listen to some of our analysts right now, they're modeling it at about a 300 million ARR or annual revenue rate. And I think this whole
That
business.
would equate to what percent of revenue
Oh,
roughly?
sorry. Our revenue is about 4 billion. Yeah,
Okay.
well, just over
So
last year,
less
just
than
over 4 billion.
10%.
Yeah, but that said, I would tell you that there are so many more areas where this can go. Like if you think about some of the, and Vlad mentioned this during the event. If you think about some of the tangents where you can go with prediction markets, they're an amazing source of information, and they have the ability for people to do things. Like for example, we have weather contract, and in the event that you have a home in Florida and you want to make sure that if a hurricane hits, it's going to protect you. Insurance can be quite expensive. A prediction market, much less so, and it makes it a lot easier to be able to hedge yourself in that instance. So that's one example. There's so many examples of ways that you can be more
Right.
precise in your investment thesis
And,
going
and so
forward.
it sounds like the way you're thinking about it, it could be more than 10% of the revenue of the
Oh,
company
it's
3
going.
years
Yeah,
from
it
now.
will be more than 10%. Yes, it'll
Like
evolve. Yes, without
50,
question.
50, 50% 3 years from now of revenue?
Oh, I don't.
How high
Yeah, I
do we
don't. Yeah, I don't know if I can project
20,
that.
30?
Yeah. Yep. Well, here, I'll give you the counter. Um, it's a very fast moving business, but we also are in a lot of other businesses that are growing quite rapidly. So, as quickly as this grows, we have other ones that are growing equally as fast. Well, not equally as fast. I shouldn't say that. This one is one of the quickest, but other ones that are growing at a pace. So it would be probably a stretch to say it's going to be 50% of our revenue.
Hmm. Let me ask you this. Coinbase unveiled its own features around predictions markets and
Yeah.
stock trading as well.
Hmm.
Why is Robinhood better than Coinbase?
I would just say, we're the original. I mean, we already have scaled businesses in all these areas. So, all the things that they're moving into, we're already established and have customers there. And, these businesses it takes time to really become a mature, accepted, and good offering. So, there's a lot of competition out there. But we've done pretty well against most of the competition. I think if you look at our our overall metrics in terms of, where we are in terms of retail percentage of equity trading in the US and option trading. We're either one or two in every category.
Hmm. And let me ask you this. I know that you got into prediction markets by way of acquisition. I believe you made a couple of acquisitions that made it easier for you to offer these products. I mean, you guys are huge. Would you ever think about acquiring a Poly Market or a Kalshi? I know it's a different business, like you said. That's the exchange, but is that
Right.
ever a move you could see coming?
Well, we just did a partnership with SIG, with Susquehanna,
Right.
and bought basically an exchange called LedgerX.
Right.
So it's a tri-party agreement, and you could really view that as purchasing an exchange, essentially. Now we have to stand it up and do all the work to get it functioning, but that we're always looking at, number one, do we do this organically? Number two, who do we partner with? And number three, is there an acquisition that we would do? And this is kind of a tri-party agreement, which I think is going to accomplish what you just laid out.
And you wouldn't think about bigger acquisitions down the road in the space?
I think we always think about them, but if you look at how the business exists today, we have the distribution. We are partnering with the largest liquidity provider. Those are probably the two most important elements here. And then, having optionality with respect to which exchange we route to, so that if one has a product that is more accommodating for our customers, we can go there, or if the economics are such that it's more beneficial and we can pass that back to our customers, we'll route to that exchange.
Great. Well, Steve, it was great to have you on the show. I want to
Thanks for
thank you for
having me.
joining us. That is Steve Quirk, Chief Brokerage Officer at Robinhood here on TITB. Okay. A major financier for an Oracle data center is backing away from the project in Michigan. That is according to a report from the Financial Times. Importantly, this facility was being built for OpenAI, which is probably why the market has been quite jittery around the news. I want to bring on Anissa Gardezi, our cloud and compute reporter, to tell us more about what she's hearing. Anissa, welcome back to the show. It's great to have you here.
Thanks, Akash.
So, you told me after yesterday's show that you are also sick.
I did.
I'm sick as well. So, but we're doing the
Everyone
show.
is, but
We're
we're both
doing the
here.
show. We are
Great.
here. We got to talk about Blue Owl. We got to talk about Oracle. We got to talk about the data centers. Why did Blue Owl back out of this deal?
Yeah, so Blue Owl decided not to invest in an Oracle project in Michigan. They weren't in a period of exclusivity and they hadn't agreed to invest, but they looked at the deal and they said, hey, this project is not for us. We're going to pass. And that has sort of sent a shock throughout the industry because Blue Owl has agreed to fund some other Oracle projects that are for OpenAI. And so now people are sort of wondering, what did Blue Owl see that they didn't like? And what I heard from sources yesterday was that the terms on this specific data center, when it came to the lease signed at the data center and the debt terms that people are talking about, were not as attractive as previous deals that Blue Owl had participated in. So they decided not to do this one. And then I've also heard that Blue Owl is a little concerned about potential delays at this site related to the local community there. And so, they did their due diligence and decided not to fund this data center. There are plenty other data centers out there, but this sort of puts into question: are other people looking at this deal also going to decide not to invest in it?
So, how big a hole was this for funding for Oracle? And could you anticipate another player coming in to fill the gap?
Based on what I can tell, and like historically how Blue Owl will do these data center deals, if they were to invest in this size of a project, it probably would have been around, a few billion. And so they wouldn't be taking the majority of the likely $10 billion site. But a few billion for Oracle is a big deal if they don't have someone else lined up. We did see the Financial Times report that Blackstone was in talks to invest. But at a project of this scale, you would likely need a consortium of investors.
Now, how is progress for this data center going, broadly speaking, on the ground?
Yeah, yeah. Just to catch you up,
the construction isn't set to begin until 2026.
Okay,
So
so we're
that
still we're still a ways away then.
Yes, but it's still a 1 gigawatt potentially site for OpenAI, and, Oracle has been moving all of these projects along very quickly, and honestly, the construction is not gonna start until the financing is lined up. So, the finance side of it definitely has to be figured out very soon. Oracle does say that they're still on schedule and that the Blue Owl decision is not delaying anything for them, but, they definitely need to find people to back this project.
And so, I'm wondering how big a deal this is in terms of uniqueness. Is this something that happens often? Because we looked at the stock reaction. I know Oracle is very jittery as it is, so any news can sway investors. But is this happening in the background more often than we think?
It is happening in the background more often than we think and than what is reported. If we reported every time Blue Owl or Blackstone or BlackRock
Changed its mind and said, "Hey,
notice something,
maybe not."
then then that would be crazy. But I think, the market reaction yesterday, Oracle was down 5%, is sort of symbolic of the moment that we're in and how much concern there is about Oracle's ability to keep raising funds to meet its commitments. They released in their 10K recently that they have multi-year lease commitments of almost $250 billion. So we're definitely waiting for the math to make sense and all of these projects to be funded. And I was also talking to a data center executive yesterday who said he's trying to raise money for something related to Oracle, but lenders are saying they're too exposed to Oracle. So some are backing out. And it's not because it isn't a good project or that they're not a good operator. It's just there's a lot of Oracle data center out there. And I think that's why the market is seeing this Blue Owl news and reacting the way they did.
Great. Well, Anissa, I want to thank you for coming on. That is Anissa Gardizi, our cloud and compute reporter here at The Information. Okay, Lyft shares are up around 40% this year compared with Uber's 25% jump. Part of the reason investors have been impressed with Lyft is the fact that the company has turned around its financial profile, generating more than $1 billion in free cash flow in the trailing 12 months. Roughly 2 years ago, it was still burning cash. To talk more about how the company plans to keep those finances intact and how it plans to continue to grow, I want to play for you a conversation that I had with Lyft CFO Aaron Brewer and also with our financial analysis columnist Anita Ramaswamy. Anita authored a column on the company last month, and she is our resident Lyft expert. Here is that conversation. Aaron Brewer, welcome to TITV. It's great to have you here.
Thank you, Akash. I'm delighted to be here.
Well, Anita and I are so excited for this conversation. There's a lot to get to. So I want to start with M&A. I mean, Lyft has done some exciting M&A recently. You bought FreeNow, which expanded you further into the European market. You brought TBR, which expanded you more into the luxury chauffeur market. Can we expect more M&A in the months to come?
Yeah, first of all, let me start off by answering that question by saying what a privilege it is for us as a team to be here where we are today. If you think back 2.5 years ago, where the business has come, it's just incredible to be at a point of financial strength that we can really think about not only growing up, but growing out. And so you mentioned the acquisitions we've done, FreeNow, which has really expanded our footprint in Europe, and then TBR Global Chauffeuring, which is just one of the pieces that really build out that incredibly important sort of luxury and really allows us to serve the business consumer in a much more comprehensive way. It's really exciting pieces of our strategy that begin to come together. I walk you through that because I think it gives you a sense for how we think about supporting the growth of the business. We're fortunate to be in an industry that has incredibly healthy organic growth and
Right.
lots of opportunity across geos. And so, we're always looking for interesting ways to continue to support that growth.
You mentioned the financial profile of the company now, and you guys have done some great work getting yourselves to more than $1 billion in free cash flow for the trailing 12 months. Those two assets, FreeNow and TBR, are they free cash flow positive?
Well, look, when you think about Free Now and how those synergies will be generated, first of all, it's a nice little business in and of itself. It plays in the taxi space in Europe, which is a premium product. And really, what they're great at doing is bringing fleets on. What we're great at doing, going to do is tweak those algorithms that are really going to raise the efficiency levels. And then you add on to that things like our partnerships, which is a huge strategy for Lyft domestically in North America today. We partner with global companies. That's going to expand. Our media business is going to expand. So there's layers of synergies where we can take that core performance and really accelerate it. The
Hmm.
same with TBR Global Chauffeuring. It's an incredible business in and of itself in terms of the top line, its profit profile, its cash profile. You put it on the strength of our overall platform, and we have incredible opportunities to accelerate that.
So it sounds like both of them are generating free cash flow. The
Yeah,
idea is
both of those businesses generate they're slightly different levels, but they do today, and they'll be positive contributions to our overall cash profile.
right. Well, last question before I hand it over to Anita is, as you think about M&A, how do you preserve that free cash flow profile then as you seek to build out the company further?
Well, look, just the organic piece of the business is an extremely strong ongoing cash profile position. So we expect to convert, we talk about it as a conversion of our adjusted EBITDA. We expect to convert that at very high levels as we look out over the next couple of years. So we see extremely strong runway in terms of healthy cash generation profile. And that's going to support what is our capital deployment strategy. And it's really kind of three foundational layers. One, ample liquidity. This is a hugely scaled business, so ample liquidity to support the operation is incredibly important. Supporting our growth, whether it's through organic growth or opportunities that we see to accelerate our growth in inorganic means, is another piece of that strategy. And then we obviously announced an inaugural share buyback program at the start of this year. $750 million is the size of the overall program, and we'll complete $500 million of that program by the end of 2025. So
Hmm.
really around reducing our share profile, ensuring that we've got our eye to that, from expanding investor value is really critical and important. Those are the three layers of our program.
Erin, I wanted to ask you a little bit about your rationale, just staying on the topic of M&A here. What was the customer research and analysis that convinced you ultimately that in these areas of your recent acquisitions, it was better to buy than to build?
Yeah, absolutely. So, if you think about Free Now and Europe, that's a landscape that's an attractive market. Those rides tend to carry higher values. Free Now had really carved out a niche in terms of aggregating taxi that we found extremely attractive and we thought was going to be a platform for which we could actually add value, right? You want to find that classic 1 + 1 = 3 in any M&A transaction. And we obviously did deep research in the markets. They operate across 9 markets, the characteristics of the market, the customer profiles. It's a heavily, business-oriented traveler. That's a great profile for us to participate in and accelerate that growth. And understanding, again, what else we could bring to the table that would ultimately be of value, both in terms of the fleet side or the driver side on Free Now, but also to the rider. We think about that very in depth. And then if you think about TBR Global Chauffeuring, this is really, again, at the highest end of a premium offerings. We have been focused on a very specific strategy to increase and accelerate the growth and the value at our premium ends. And in the third quarter of this year, for example, what we've talked about is that growth at that higher end piece of our ride offering was up 50% year over year, and we're just getting started. So TBR really adds a capacity as we think about, in particular, targeting that business traveler, engaging with partners around events to provide, in addition to the core premium rides that are available on the platform, really that next level of incredible service that really round out the offering and make us differentiated in the market.
So you talked a little bit about TBR. I wanted to double click on Free Now a little bit, Erin, because I listened to you talk at the NASDAQ recently, and you mentioned a lot about smaller cities in the US and how these underpenetrated markets in North America have been a great source of growth for you. Free Now obviously is based in Europe. You guys have also been expanding a lot in Canada. And I just wanted to ask, what are your geographic expansion plans, big picture going forward?
Today we're obviously incredibly focused on where we operate. The US and Canada, our traditional markets, still have strong growth opportunities ahead. You've mentioned underpenetrated markets in the US, which has been a strong source of growth. And don't forget, even in 2025, we continued to launch new provinces, new cities across Canada. So as we think about 2026, again, a lot of runway for growth. And then Europe really presents a new front for us. And so the teams, as we closed the acquisition in the recent months, got right to work in terms of capturing that initial, beginning to capture that initial synergy profile in terms of just improving the core way that that business operates. And we're really excited for what comes ahead. So we've got a lot on our plate to execute that we're excited about, and a number of different growth trajectories that we're pursuing. So we're very focused on that.
I think it's a good time, Erin, to get into a topic that is top of everyone's minds today, especially after our story earlier that Waymo is in talks to raise funding at double its last valuation. I think everyone is thinking about AVs, using AVs in San Francisco and other cities.
Mhm.
You guys actually bought an interesting asset in 2020, FlexDrive, and you've been using it to service and clean some of the vehicles associated with your partnership with Waymo. And I've just been thinking, Uber also, your competitor, has similar partnerships with Waymo, but they've taken a different approach. They use third parties for sort of servicing and cleaning the cars. So I wanted to hear from you. Has owning FlexDrive been an advantage? And how has that helped you?
We absolutely think owning FlexDrive has been an advantage and will continue to be an advantage. At the advent of this industry on AVs, which is still frankly quite nascent, I think people sort of forgot for a minute that having very high availability of this technology was a critical foundational layer, right? If a vehicle isn't available to be deployed, to be hailed, then you're not optimizing your revenue generating opportunity. And in order to do that, you need to have incredible operational excellence behind it. We knew FlexDrive was absolutely going to be a superpower, a secret weapon, if you will, in that overall mix and in that conversation. And we have high confidence that it will continue to be. What's unique about it is, yes, it's a fleet management capability. We own over 10,000 cars today. We operate in over a dozen major cities with physical centers. So that's important. But what's incredibly important is it's optimized for rideshare. And that's incredibly unique, and we think is going to be incredibly valuable as we think about the continued build out of the AV landscape, as you think about ride hailing in a hybrid world.
So it sounds like then, with respect to margin structure for autonomous vehicles, I mean, if you look 3 years out, how do you think it changes your margin structure?
It's interesting because today what you see across not only Lyft and all of the partnerships that we're engaged in, but across the industry, you see a high level of experimentation with many, many different models. That I think will continue for certain over the near term. And as people begin to, figure out the models and more importantly, figure out exactly where they want to play, and I'm talking up and down the value chain, I think then that will be the point where we'll come into focus about exactly how it will fall into our overall P&L structure. But what I can say to you is that we are incredibly excited about the advent of AV technology. We see today that it expands the market. We see that in the cities where AVs operate and have
Right.
been operating at some scaled fleet. And we know and have high conviction that a hybrid network, so the ability to service riders incredibly efficiency, whether it's a human driver, an autonomous driver, is going to be the winning model. And so net, this is great not only for our top line growth, but as we
Right.
continue to seek to expand margins.
But I guess as you think about that, I mean, do you think that prices in the long term will have to come up to be able to offset the margins? Do you see the costs coming down? How do you think about that?
If you're talking specifically about autonomous vehicles, you have
Yes.
to go down a laundry list of sort of assumptions and inputs. The most critical being around how will the hardware ultimately scale and where will that cost land? Then you have to understand where will the regulatory and sort of insurance structure land overall. And so there are a number of years here for that to develop so that we know those inputs with a lot more certainty at scale. And I think that will influence ultimately see where the pricing dynamic lies in the overall market. That being said, I do think we will reach a point at scale. It's certainly not going to be next year. It's going to be multiple years down the road where that all becomes, much more into focus so that we understand the structures. But ultimately, if you think about whether it's autonomous, human-driven, the hybrid network, this has become really an essential way that people get their transportation needs met. I think autonomous will expand that overall. And so it's critical that we continue to be able to deliver a competitively priced service that
Hmm.
delivers very, very high levels of service.
I think it's clear that we're in earlier days in terms of AVs, Erin, but one area where you guys have expanded a lot already is by adding all these new partnerships. You have partnerships with DoorDash, United was one that you talked about on the last earnings call, Hilton. And I just wanted to ask, this affects your long-term margin structure as well. In these sorts of deals, who is paying who?
These sorts of deals, generally are constructed where both parties are contributing, right? So you've got a co-funding mechanism. And that's incredibly important because to build durable partnerships, you need both partners to be really in it to win it. And what that means is you go into this understanding that both have a deep interest in, introducing new riders or new consumers to the service, building loyalty, building high engagement, building higher frequency. And you see that throughout the life of a program with investments, with different campaigns to grow it over time. And Lyft has a track record of doing that very, very successfully. Rides that are tagged to partnerships have grown significantly as part of our overall profile. And those rides, contain very, high quality characteristics, meaning those riders tend to take a higher mix of higher value rides. So they tend to bring higher than average profitability. So deepening our partnerships and continuing to penetrate that opportunity has been a huge focus and will continue to be so as we think about 2026 and beyond.
Can you give us a sense of what that funding split might look like for any of your bigger partnerships? Say, let's take United.
Yeah, it varies by partner, so I'm not going to go into details, but it tends to be balanced, and it really also is informed by what stage of the partnership we're in, what cohorts we're going after. So that's sort of the general color that I'll provide.
Got it. So, moving to another area, Erin, the FTC, we got news this week, is suing Uber over its Uber One subscription program. And I've heard you guys say a lot before that you're fundamentally a rideshare company. You're not looking to get into any other areas outside of riders and cars.
Okay.
And I was just wondering, where do you personally spend the most time in terms of thinking about regulatory affairs? I mean, is it insurance? Is it worker classification? Is it something else?
Yeah, I mean, first, maybe touch on your initial point, Anita, because I think it's a great segue from what we were just discussing in partnerships, right? So, riders on the Lyft platform and the way they engage with partners are very, very different. So, you're someone who loves rideshare and you also love food delivery. We've got the best offering in the industry with our Lyft and DoorDash partnerships. Same with United, et cetera. So, we think that's a great model, and we're excited to continue to grow that. In terms of the regulatory landscape overall, it's important when you operate a service that is so essential to the transportation environment that happens with cities that you go into it with a mindset of really partnering both locally at a state level or federally. And that is the way that we have gone about this as a company. We think it's been a winning model overall. It's something we also frankly really liked about FreeNow. And so the regulatory environment is present in all aspects of our business. We partner extremely closely and we think about it from the lens of, some of um, the areas that are more present has been around some of this reform in California around insurance, which we're excited about. It's going to kick off in 2026. And we think that that could present a canvas, if you will, for other states to do some accelerated, what we view as common sense reform in overall rideshare insurance marketplace in the United States.
So, Erin, I gotta ask, you're a CFO, you make tough capital allocation decisions every day, I'm sure. What is the toughest one you've had to make in the last 6 months?
I say this to the team all the time. It's also relevant because obviously we are wrapping up some of our planning processes for 2026. We do make tough decisions, and the team will tell you sometimes it's not fun, but I remind them frequently. I'd rather be in this position than in any other position because we are in a growing, vibrant industry, and we have more great opportunities that would be possible for us to invest against, whether that's resources or capital, than we could probably fund. So our job is to be discerning and try to be, extremely smart about the areas that we invest. So it's always tough, but I'll take this problem over the alternative problem any day.
But Aaron, what decision kept you up at night last? I mean, we're looking for, was it a deal? Was it an acquisition? Something must have kept you up late trying to figure out if this was the right decision.
I wouldn't say that any of them have kept me up in terms of, are we making a mistake or not? What keeps me up is when we look at the different pathways we could take, and what the opportunity is. How do we make sure, given the variety of inputs, that we're choosing from the right category? So,
Right.
confidential, so I'm not going to go into it right now, but that's where I spend more of my time worrying than frankly second guessing or, worrying about a particular decision. We've got a couple of very attractive choices. Do
Right.
we double down? Do we kind of spread our bets, if you will, for where we are? Those are the things that we really think deeply about.
Where do you think Lyft is 3 years from now?
Oh my gosh. I mean, we're just on an incredible trajectory today. I think Lyft is the innovator in the industry. I think we are the service leader in our industry. I think we will continue to expand that across Europe, continue to expand that across Canada. I think we'll continue to penetrate deeply in our rider-facing partnerships. And I think we will be sort of the poster child for what it looks like to have an extremely successful hybrid human-based, autonomous-based ride-hailing network. So that's where I see us 3 years from today.
Great. Well, Aaron, it is so great to have you on the show. I want to thank you for joining us. That is Aaron Brewer, the CFO of Lyft, and Anita Ramaswamy, our financial analysis columnist here at The Information. The co-founder and CEO of Axios has a new warning out for journalists saying we have entered a, quote, post-news era where information is what matters, not the news. Jim Vandehei wrote this in a memo shared with Semaphore. The Information's founder and editor-in-chief Jessica Lessin sat down with Vandehei for a conversation about what that post-news era looks like for newsrooms. Here is that conversation.
Well, I am so thrilled to be here with Jim Vandehei, who has been an outspoken leader in news about what is to come. So, Jim, thanks for joining TITV to tell us about your latest manifesto, if you will.
It's always a treat. Good to see you, Jessica.
So you wrote this week that we have entered the post-news era. This is a little jarring as a news person, but tell us what you meant.
Yeah, I mean, you have the perfect name, right? It's much more about information now. And if you think about the individual, 20 years ago, 10 years ago, maybe even 5 years ago, most of how they saw the world was shaped by news, right? But now news is a part of it, but it's also by the podcasts you listen to, the videos that you watch, the people who show up in your social media feed, your social circuit. And to me, this is a huge, huge, huge shift that most companies and most individuals have not grappled with. It's no longer like red America, blue America, or we have like a couple of information bubbles. We might have millions of information bubbles where really smart people in close proximity to each other could have pretty different realities based on where they're consuming their content, right? So if you and I could both play this game. If you told me how old you are, what you do, what your politics are, I could probably tell you where you get the vast majority of your information. And it's possible that you could be sitting with somebody and they're on a platform you never visit, right? They're trusting people you've never heard of, following topics that never really come across your radar. That's wild. That's different. And that has huge, huge, huge political consequences and massive, massive business consequences.
And have you seen something lately that you think is exacerbating this? I mean, I think you connected it to filter bubbles, but, to the nth degree. But I wonder, in running Axios this year and in all the conversations you have, are we at some kind of inflection point of acceleration, or is this kind of just calling a moment that we've been late to call?
I think we're in. Listen, I think as long as you and I have been talking, we've been in this hyper volatility world, and I think it's about to be put on steroids. I think I'm highly confident that in the next 12 to 48 months, we're going to go through a massive platform shift that will move from kind of web and search to something that is LLM based. And you have so many different choices. You have really high quality content coming from people on YouTube, from people with podcasts, from people with sites, people with Substacks, people like you and I with companies. That means that the whole mix it's just different. It is like, that's why I say it's post news. And I think most people don't think of news like you and I do because we got into the business. They just think about, how do I get informed? Like, how do I take inputs so that I can make really good decisions? Unfortunately, there's a lot of pollution. I think there's more good. The paradox of the moment is there's more good content than at any point in humanity, and there's more crap content than at any point in humanity. Yeah. And for those of us that can make really healthy choices about the inputs, I don't know about you, but like, I feel like I have almost a bionic brain these days because I know who to follow. I know what to read. I know who the smart people are. I know what the right publications are. I feel like I have more visibility into more things than ever before. But we're also in the business. We know these people. We've hired them. We fired them. We've read them. We've worked at these places. So we were able to do that. And what I hope to do with Axios is like help other people try to get to this approximation of a more bionic brain. Like, get rid of the crappy stuff, put in the really good stuff, and you can make much better decisions. Like, think about even for you and I, like 5 years ago, 10 years ago, if we wanted to know what the smartest people in the world thought, like maybe once in a while we got them on the phone, but now all of us have access to it. All of them are doing podcasts.
Well, we know what they want us to think. So, I mean, I think this is part of your theme of being post-news is we're also in full-on propaganda. We're also in full-on, storytelling. We're in the era of don't let the facts get away of a good story, with some of the most powerful people in the world. And it's not one, it's many of them, right? I see it in the technology industry every day. And so I wonder what's the prescription or recipe for news organizations, right? That are on one hand fighting that propaganda, but also, have to face the reality of declining trust and, even declining visibility. And I want to get back to LLMs too, but that's a long enough question. So.
I think listen, you hit the nail on the head. It's a massive problem for some business models. But I think what you have to do is you have to do what you're doing, what we're doing. You have to tighten your relationship with the consumer. Like, you have to have this relationship of trust between you and the people consuming your content. And to deliver that, you have to have distinctive content. You have to have distinctive reporters providing things that no machine can provide and that their competition can't provide. And what I think will happen, like you and I spend a lot of our time thinking, what does the world look like in 18 months? From a news perspective, I think that if you have a company like yours, a company like ours that are built around expertise for very distinct audiences, I firmly believe that content is going to be worth 5 or 10x in the new world order what it is today, because everyone else is going to have equal access to general high quality information at their fingertips on almost any topic. What the LLMs and what the individuals will pay for is human nuance, human expertise, human experience, analysis and insight that is distinct from people who've been looking at these topics, talking to the people person to person. I think that soars in value. So if you're you or us, I feel good. If you're producing generic commoditized content, I felt this way for the last 10 years. I feel it more powerfully today. You're screwed. There's not going to be a market for that. The LLMs
I printed out the crap trap. So this was I don't know if people can see here, but 9 years ago, Jim wrote in an op-ed for The Information, probably one of our first op-eds, that digital media companies are caught in the crap trap, mass producing trashy clickbait so they can claim huge audiences and higher valuations. And I think you call it, and I had to, this was largely a social media story at the time, right? The social media companies were the distribution channels du jour. And so anyway, everyone should check it out and we can link to it. But it was prescient to say the least. And you also nailed the rise of video, which, here we are. So obviously that's happened. But I wonder, I couldn't agree more with everything you're saying. I mean, one thing I've been toying with in my brain is, or just struck by the rising cost of getting to the truth and doing what journalists do. You talked about how, there will be value in being specialized, but I think, whether it's just the fact that there's so much obfuscation, so much propaganda, if you survey 40 editors at top publications, 40 will say their legal budgets are significantly increasing. The topics are getting more complicated, so the level of reporters you need is more specialized. I wonder what you think of that, and does it play into who wins and loses over the next 5 years?
Well, I think about the cost thing differently. I agree with you. I agree legal costs probably go up, and I think the cost of talent goes up. I think the cost of everything else drops precipitously. We're doing
distribution, all that.
Everything. Listen, we're not a technology company. We're not necessarily a marketing company. All of the stuff that sits behind me creating content and you consuming that content, all of that can be automated, and I think will be automated in the not too distant future. That takes down a massive part of our cost structure. I'm sure if you looked at my budget, I looked at yours, we allocate a similar percentage to talent because we're talent-based
a lot.
organization.
That would be a lot.
Yeah, but you want to squeeze that other side so you can put the money in the other place. So I think that I think it more than evens out. I think these become better businesses that you can run on better margins. But they are really going to very specific people who have a real desire and demand for high quality content, which isn't most people. It's not going to fix a propaganda problem. It's not going to fix a manipulation problem. And and I know that problem is going to be 10 times as bad 18 months from now as it is now. Every new technology, even if it ends up in a beautiful place, we're going to go through hell. This spin that the idea that AI is just going to be nirvana, we're all going to be sitting home not having to work and we're learning poetry might be true 10 years from now. It's bullshit in the short term. It's going to have real pain for jobs, and it's going to have real pain in conversion, and most humans, when they get a new technology, use it for perversion, and foreign actors use it for perversion. And so we're going to have to grapple with all that. I believe on the other side of it, it could be big, could be beautiful, but there's going to be real tumult in between there.
Okay, so last question. You're a news org, like the Information or Axios. You see this AI train coming. What do you do?
I mean, I think what we've done is we try to get ahead of it, we know these companies, we know the principles. And so we've really, a year ago, I had a speech to our staff and I said, I know you're worried about AI. I know you think it's going to take your job. From this day henceforth, I don't give a shit. I'm going to equip you as best
I'm going to take your talking points, Jim, and just see how they fly.
No, it's a good one to have. I tell all CEOs they should do this. People don't want to talk about it, but just tell your people, listen, if you can't take AI in any technology and make it a force multiplier of the work that you do and do it right away, not just here, you're not going to have a job anywhere. And so what I said is that's the reality. We gave everybody a free license to use OpenAI as much as they want to be able to use it, the industrial version. And then we said, listen, I want you to spend 10% of your day just figuring out how to use it to do the specific work you do. When you have a win, share that with other people here that do the job that you do. And then together, we can at least try to come out in the best possible position on the other side of it. And I think that's what every company should be doing. It's certainly what I assume you're doing. It's what we're doing. And that doesn't mean it's not going to be scary. It doesn't mean it's not going to change the nature of work. It will. It doesn't mean it's not going to eliminate some jobs. It will. But I think the smartest thing you could do is be eyes wide open. The minute you think you can utilize it, utilize it. And ultimately, I think it helps on the back end. The stupid bet being made right now, I think, is all these companies investing in producing actual content for the consumer using artificial intelligence. Your LLM garbage spitting out something to the consumer might work in the short term, maybe. I don't think it will, but it's not going to be useful in the future. And video made up because you have some AI techniques built into it. I just don't see how that's going to have value because the machines are always going to do it better than any media company can. So figure out what do you do better than anyone else and no robot can do. And if you do it better than anyone else, you will be able to extract value. You've done it. We've done it. Others will do it. It'll be different. It's not going to look like the media landscape of the past, but whatever, that's life.
Yeah. Well, I love it. And I'll just add, too, that I think publishers have to hold their own ground and recognize that there, in my opinion, aren't really yet benefits to licensing these content to the LLMs for the same reason. There aren't the products that, you can even say would justify the distribution and the money and the growth and the reach from partnering. So
that one we might disagree because we've done a deal with OpenAI. I think it depends on the economics. Just know what the other company's trying to get out of it. Are the economics good enough for you based on what you think the future will hold? I think I'm right with you. I'm with you usually philosophically on this because I think one of the dumbest things that media companies did was tether their future to social media companies giving them deals to do content deals or video or shows.
I mean, it was destruction. BuzzFeed News doesn't exist, right? I mean, I was like, we wasted a decade. Yeah.
No other company, no other industry would outsource their destiny to a third party's benevolence. That's stupid. You can't do that. And I think that's where people have to be thinking about if the deal's great economically and you think it pays off over time, do it. But also understand that we don't know what it needs yet. We don't know if having no deal puts you in a better position to be able to provide distinctive content through an LLM or sit outside of it.
And I just got to tell you, Jim, sitting out here in the Valley and talking to these companies, they don't know what they're going to be yet, these AI companies. Are they research labs? Are they product orgs? Are they in the subscription business? Are they in the advertising business? Are they search 2.0? Or are they something else? So a caution to publishers, shall we say. But Jim, it's always a pleasure. We've got to do this more. Thanks for joining us. And everyone should check out Axios to see where you wrote more extensively about these thoughts this week.
Awesome. And congrats on all your success and happy holidays.
Thank you.
Okay. YouTube made big news this week with its announcement it will stream the Oscars starting in 2029. And on a slightly different but related note, TikTok is hosting its first TikTok Awards in the US tonight, which is being streamed on the platform and also on Tubi. To talk more about the media landscape at large, I want to bring on Anjali Sood, CEO of Tubi. Anjali, welcome back to the show. It's great to have you here.
Thank you, Akash. It's good to be here again.
So I want to talk to you a little bit about media right now because it's kind of a crazy time. And, in the background, we've got the Warner Brothers, Paramount, Netflix saga, which is continuing to play out. I think it's anyone's guess as to where this all ends up. But the question I want to start with you is, what impact do you think this consolidation will end up having on the content and the films and the TVs that will end up being produced in the end?
Yeah. Well, it is certainly a fascinating saga. And I think ultimately consolidation is natural and appropriate and expected in the media industry right now. Consumer needs are evolving and we have to adapt. I think the way Tubi looks at it, we have a very diverse and diversified collection of content. We work with creators, some of the world's most popular creators. We work with Hollywood. We work with independent filmmakers. And we expect that there will be even more stories and more storytellers that we will be putting in front of our audience in the future. So certainly there will be implications from consolidation. But I actually think the real story here isn't who buys who. It's how is the future of streaming going to evolve as we see this convergence between social and the creator economy and Hollywood. And you mentioned YouTube. YouTube's got the Oscars. I think Instagram is now putting vertical videos on TV. You've got Tubi streaming the TikTok Awards. We are seeing this convergence. And I think it's really going to force all of us to think about how are we meeting the next generation where they are.
So I want to get to all that, but level with me here. Do you think this consolidation is good for filmmakers?
I think there's going to be fewer players, but the general trends I don't think change here. At the end of the day, the real trend is that we are in an attention economy and there's a battle for everyone's mind share. And there will be, I think, with AI and other trends, you're going to see just more stories and storytellers that are out there. And for me, I think the question for filmmakers is, how do you help every content creator and every story find its audience? And so I actually think there's a real tailwind for platforms like Tubi that are really good at taking a broad set of different kinds of content and
Right.
helping put it in front of the right viewer at the right time so that those stories can find their audience. Like, to me, that's the tailwind that I think will carry forward, not just this month or this quarter, but for the next few years.
Right. Now, you mentioned AI. The other deal that has happened since we last spoke is the Disney OpenAI investment. What did you make of that deal?
I'm not surprised. I think you're gonna see more and more of these kind of partnerships, and I think ultimately it's because there is an opportunity for AI, if used in the right way and responsibly, to democratize storytelling, to enhance creativity.
Right.
It is the job, I think, of media companies to be willing to experiment and to be willing to figure that out. And I can tell you at Tubi, we are doing a lot of things using AI to
Do,
make.
do you have AI content on AI films on your platform?
We don't yet.
Okay.
But I would tell you, we do use AI for a lot of other things, like figuring out how to help you find what to watch. One of the craziest stats is that the average American takes more than 10 minutes to find what to watch every night on
Yeah. Yeah.
Netflix.
I take longer than that, by
Yeah,
the way.
I think I do too. And
Yeah.
think about how when you open up, TikTok or Instagram, like if you don't get something interesting within seconds, you bounce. And so I think there's a huge opportunity for AI there. I think with advertising and helping more brands create content that they can put ads on TV is another big area of opportunity. And then I do believe that AI will make it easier. It'll lower the costs and increase the speed for high quality production. And that can be a good thing for the industry if we sort of navigate that transformation in the right way.
Let me ask you this: would you ever do a deal of some kind with OpenAI? I mean, I don't know what such a deal would look like. I imagine it could be something around, hey, we give access to maybe our filmmakers. I don't know. Sky's the limit here. But would you ever do a deal like that with a model company?
I mean, we're different from Disney in that we don't have the same kind of franchise
Right.
IP, but it is our responsibility, I think, and opportunity to find ways to work with the biggest AI players to unlock that technology and harness it to enhance creativity. That is our job. You will absolutely see Tubi look to experiment thoughtfully in the space. And like I said, I don't think we'll be alone in that.
Right. Okay. So let's talk about the TikTok awards. They are happening tonight. Where are they happening? Are they Los Angeles? Are they
It's in
New
Los
York? It's
Angeles.
in LA. Okay.
Yeah, it's gonna be
And
great. We've got, it's a celebration of some of the biggest creators at TikTok with a lot of entertaining talent.
okay, and I want to get to the nominees in a second, but did you have to pay for the rights for this? How much did you have to pay?
This was actually just a really, I would say, more strategic partnership between Tubi and TikTok to kind of expand the audience of people who can tune into the awards. And it's also worth noting that Tubi has been really doing some interesting things with TikTok creators for a while now. We cast TikTok creators in Hollywood films, probably our biggest franchise ever. It's called Sidelined. It stars a TikTok creator who's also a producer. It's had nearly 20 million viewers to date, all through viral marketing on TikTok. And as you know, Akash, we've also been bringing creators onto Tubi's platform. We have over 10,000 creator-driven titles now, and we are working with creators to help them kind of graduate into Hollywood, elevate their long form storytelling, and really just expand the pie so that they can do more projects, make more money, and be more successful. So I think it's much more of an alignment and sort of that acknowledging that convergence is happening. How can Tubi and TikTok work together to do that?
Do you have a favorite creator that you're rooting for tonight? Do you have to be neutral
I,
on this, given that you're the distributor of some kind? I mean, can
I'm
we make
I'm
picks?
rooting I'm rooting for as many people on in to
Yeah,
between.
but there can only be one winner, Anjali. Everybody can't win. That's the point of the awards show.
Well, I will say there's actually numerous winners. There are multiple
Right. Yeah.
awards, but I do think what's interesting about the creator economy in general is there are actually multiple winners because we have such diverse tastes, and there are creators that speak to different fandoms. And I actually
Right.
think this is a common theme you're going to see. I think not just from creator platforms, but from platforms like Tubi, which is acknowledging that like fans have different tastes and needs, and it's our job to like help them connect them with the storytellers that are inspiring them.
Great. Well, Anjali, it was great to catch up. Thank you so much for coming on. That is Anjali Sood, the CEO of Tubi, here on TITV. Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I'm already excited for our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.